A very good afternoon and welcome to HYCM's online live workshop with myself, Giles Coughlin, Chief Currency Analyst. Very nice to see you here, particularly welcome if you're new today, just looking forward to going through the main events, taking a quick snapshot of where we are at the market, and then we have a number of very exciting and potentially significant economic events on the second half of the calendar for this week. So we're going to be going through some of those key messages. Just remind yourselves that as we take this workshop, the whole purpose of this workshop is to provide an educational framework so you can see how someone with a professional trading background and a professional analyst, how I go about understanding the market dynamics, how I understand those bigger fundamental pictures that influence all financial markets, and how I use that in order to make a trade. Now, the whole idea of these webinars and workshops, they're not trading signal services, even though I talk about entries, exits, different instruments that I'm looking at trading. It's all from an educational perspective. So those of you who have been attending these webinars for some time are well aware of how they work. And if this is your first time here today, that's just to make that clear. Now, these are the key topics we're going to be looking at today. We're going to be looking at, first of all, the main event of the week is the Federal Reserve. Now, remind yourselves that central banks are not all created equal. We have Bank of Japan, Swiss National Bank, Bank of England, but the king of all the central banks is the Federal Reserve. And today we have a Federal Reserve interest rate meeting. You know, central banks meet about 8, 9, 10 times a year. And at those meetings, they set the interest rates, which sets the borrowing rates for banks and for the consumers of that country each, every couple of months or every month. Different central banks have different timetables. I'm going to go through what to expect and how that might impact the dollar, how might that impact gold and euro US dollar. We're also going to have a quick look at the pound. We had some interesting data out for the pound with the CPI data. Going to run through that, what that means and what might that mean for next week's Bank of England meeting. Got Australian employment data, going to run through that, New Zealand GDP, and what to expect from the Swiss National Bank meeting tomorrow, how that could impact the euro Swiss franc, and also look at some of the data building up to the Federal Reserve announcement, including that US consumer data we saw of US retail sales yesterday. So we've got a lot to cover, but really looking forward to getting stuck in. Now, remember, if this is your first time with us, or maybe you're trying to get your head around how to trade, and maybe you're finding it a little bit tricky. Well, let me tell you, there's a very simple mental image you should have in your mind that I teach all my students, and particularly when you're beginning, you want to have this very simple image in your mind. You see, you've got a strong arm on the left, and you have a comparatively weaker arm on the right. Now, if you had to guess, which arm is going to win this arm wrestle? Well, you'd say, Giles, it's obvious. I would expect the stronger arm to win the arm wrestle because this arm is weaker compared to this arm. And, most times you'd be correct, wouldn't you? The stronger arm should be more powerful than the weaker arm. Now, when we're trading, what we're looking at trading strength against weakness, except it's not arms. Remember, currencies are traded in pairs. So when we're trading in pairs, we're looking to trade a strong currency against a weak currency. So we want to find reasons that a currency has strength and trade that against reasons that a currency has weakness. And by comparing the strength and the weakness in the two currencies, that enables us to have a clear bias in our trading. So whenever you're trading, always think to yourself, am I pairing a strong currency against a weak currency? And if you have that mental idea, and particularly if you're trying to help other people that don't know what to trade, maybe they don't know how to trade, they're starting to find their feet, the area you want to direct them is you want to find reasons a currency has strength as opposed to a reason a currency has weakness. And let me show you an example on the chart so you can just get this very clearly into your mind. Now, There was a trade that I took in April. Now, on April the 21st, we had the Bank of Canada interest rate meeting. Now, interest rate meetings are the most significant economic events for currencies during the course of the year. So whenever there's a central bank meeting, pay attention. Now, if you want to understand what the central bank's meeting, we provide everything that you need here at HYCM. If you just go to our blog at blog.hycmlab.com, I'll just pop that into the chat box. This is the website. Just go to blog.hycmlab.com and you will see the blog. Now, at the home page, just go to Market Fundamentals and go to Central Bank Watch. And if you go to the Central Bank Watch, you'll see all the interest rate decisions being made. Now, if we go back to, it was in April, so we'll look at the April and we'll see what did we learn from the Bank of Canada. So there we saw the Bank of Canada, we saw that there was a hawkish shift. Now, in currency speak, hawkish means you're buying, you're expecting the currency to go to gain, to be strong. So anything hawkish, you think of a hawk, it's predatory, it's fast, you know, it's a buy. A dove, it's passive, it's gentle, it's a sell. Now, don't worry, we haven't got anything against doves, and we're not, you know, pro hawks necessarily. They're both beautiful birds. It's just a language that's used to communicate whether the currency is expected to be strong or weak. Now, what happened is the Bank of Canada had a hawkish shift because of the time that we've got. You know, I won't go into this in a lot of detail, but here I showed you a potential opportunity that was there at that time. Also said that US dollar CAD shorts would be reasonable, looking to fade rallies. So this was into April, and you can see here, look, after the April meeting, you see the way the Canadian dollar strengthened all the way down. So that's 500 points lower. Why? Because of a central bank shift in its policy. The markets are very sensitive to interest rate rises. Now, when an interest rate rises, what that means is you get rewarded for holding the currency. So that means when you're expecting an interest rate rise, it means people like myself and money managers all over the world, they move their money into that currency that's about to have the interest rates increased. Why? Because you get more money by having your currency in that country's denomination. So if the Bank of Canada are going to raise interest rates, what do you want to buy? Canadian dollars. So remember that image that I shared with you? We want to strength against weakness. So here in this example, what did we suddenly see? We saw suddenly reasons for Canadian dollar strength, and the US dollar didn't have the reasons for the strength. So in comparison, if we look at this again, we can see that in comparison, the Canadian dollar was strong, the US dollar was relatively weak, which meant expect the US dollar CAD to sell. Right. Once you've got that concept in your mind, it will help you greatly. Now, I was speaking at the Murdoch University of Dubai this week to some financial students about understanding how that relationship between monetary policy impacts currency markets. Now, I highly recommend you watch that video. It's only about 40 minutes long, but it will give you a great understanding of this concept of strength versus weakness. So if you have some time to do that during the week, I will put it up on my Twitter feed. Make sure you're following me here at Twitter. It's at Giles Coughlin CCA. Just put my Twitter handle in there. You can follow me there, and I put up loads of good information up on my Twitter page. And you know, follow me there, and I will put up that latest link from the Murdoch University of Dubai. If you're new to currency trading, or if what we're going through today is going to prove maybe challenging, or even if you're a seasoned pro and you think, yeah, I've got it all down, watch that video. There will be something in it for you to help you. And you know what it's like in life. It's always good to go over the fundamentals, isn't it? Because it just reminds you of the basics. And many people, particularly retail traders, have no understanding of the underlying underlying dynamics that actually move in financial markets. Remember, these financial markets are not random. They are moving in line with government policy and central bank monetary policy. It's not just that these prices are just moving willy-nilly, randomly up and down on the screen. Now, when you first come to trading, you might be forgiven for thinking they are, but actually, as you slowly unpick the reasons, you see there are often very key times when markets shift in very predictable moves. Okay, so first thing to go up today. Now, one of our partners is Financial Source, a great partner that we have, a very reliable team of analysts who work here. So we've been very pleased to partner with the team here. And one of the great resources that is available to you as an HYCM client is we wanted to give you the very best. We really have given you the very best, because this terminal also has an audio squawk, which is the same audio squawk that professional traders use all around the world. And this news feed is the same news feed that is used by the majority of professional traders all over the world. This is essentially a news squawk, and that's based on Reuters news feed. It's very, very reliable and market moving. Now, a couple of things to say. So the first thing to talk about is the pound. Now, if I said, now this is all about learning about expectations. Now, if I said to you, if you come to my house, when you come to my house, if I said to you, we're going to have a sandwich to eat, and then we're going to sit in my garden, and I'm going to, make us some tea, and we're going to have a nice chat together. Right. Now, you come to my house and you think, well, that's great. That's what I'm expecting. But when you come to my house, I say, no, do you know what? We're going to do something different. We're going to take the train down to London. I'm going to take you out to the Ritz Hotel. We're going to have a 3-course meal. We're going to spend the night in London, and then we're going to go around some museums. We're going to take some photos on London Bridge, and we'll even pop by and see the Buckingham Palace if we've got time. Then you think, wow, you see, I would have exceeded your expectations. Trading works in exactly the same way. Traders are always looking what they're expecting to happen. Now, next week, we have the Bank of England interest rate decision. Now, today we had an inflation print, and this inflationary print, which is the CPI, that's called the Consumer Price Index, and that is the inflation metric. Now, the core inflation is the most important reading, and that came in at 2%. Do you see that only 1.5% was expected? So do you see how the inflation exceeded what was anticipated? So that's 2%. Now, in the narrative at the moment, the UK, again, you can look on my blog, you can see the Bank of England, all my Bank of England reports that I've done. The last couple of Bank of England's reports have been very bullish. In other words, they've been hawkish. They've been pointing towards more upside. So although they didn't make any changes, there was some confidence in the minutes. And that upbeat nature of the minutes means that the general feeling amongst investors is that the market's expecting the Bank of England to taper their bond purchases. Now, bond purchases is the quantitative easing program, which basically, money can be physical, like the coins and the notes in your pockets, but money can also be digital, like the money in your bank account. You go to bank account, you check your balance on your computer. It's not that the money's actually sort of there. The money is digital. So quantitative easing is the creation of digital money, and it's used to buy things like government bonds. And whenever a central bank starts a quantitative easing program or expands its quantitative easing program, it increases the money supply into that economy, and it causes the value of that money to fall. So when a central bank cuts bond purchases, that means they're reducing the money supply, so they cause the money denomination to rise. Now, the way that central banks can control inflation is very simply by raising interest rates. So inflation is the costs of goods and services. So imagine you go to your supermarket and you do your grocery shop for the week, and imagine that you bought everything you need for the week, and let's say it's cost you $100. Now, say you went back the next week and the same products cost you $110. Well, that would mean you've experienced inflation of 10%. Now, central banks do not want to allow inflation to become too high too fast. So as a consequence, what central banks do is they try to control inflation, and the Bank of England's target is to have inflation at 2%. Now, if the inflation is at 2%, what does that mean the central bank is more likely to do? Well, it means the central bank is more likely to raise interest rates. So what would you expect the pound to do? You expect the pound to gain in value. Okay, so that's why this morning, from early in the morning, when we had that that CPI data out, that's why we saw the pound gain in value. Now, obviously, there's nuances to the story, and the nuance to the story is that most central banks are expecting inflation just to be transitory. They're expecting a little bit of inflation because of COVID-19. So maybe suppliers were unable to get all their goods and materials to producers, so they've had to pay more for raw materials. And maybe there's just things like, oh, it's due to air flights costing more. Those kinds of things have been forcing inflation higher. But what this means that the Bank of England are more likely to taper bond purchases, and they're more likely to raise interest rates, which means the value of the pound potentially moves higher. Okay, so one very interesting potential trade to look at is potentially a pound-yen potential buy. This is a trade that I'm looking at. And it will only really be valid after the FOMC meeting, because that's quite a risk. But you can see that the bias is for the pound to keep finding buyers. The UK has an economy that's about to open up again. Yes, it has been delayed, the reopening of the economy. That did mean a little bit of retracement in the pound, but that delay is only going to be now until the 19th of July. It's 180 billion pounds worth of savings ready to be released in the UK economy. The chief economist of the Bank of England, Andy Haldane, has said that the UK economy is going gangbusters. The housing market is really hot in the UK, which means interest rates are more likely to rise to control that explosion in house prices. So there's a lot of fundamental factors that mean the pound yen should find buyers. Now you can see here, the best area to buy the pound yen would be a deep retracement to that 152 area. That would be a great region. But also, it is possible to buy the pound yen at market and just keep your stops below that near-term trend line. Okay, and looking for a break of 156 up towards 158 and above. So that's a kind of situation I'm looking at, because the Bank of England are meeting next week. The economy is going good. Inflation is high. It means they're more likely to take bond purchases. They're more likely to raise interest rates. So the anticipation, maybe like from the start of next week, would be to see some pound strength. Now, the Japanese yen at the moment, it's on a global growth trajectory. With global vaccine rollout, the Japanese yen tends to lose value. So pound is potentially the strong currency, yen is the weak. And you can see how the pound has just been, pound yen, buying, broke through that trend line, soar through that trend line, So you can see that fundamental bias is there. That's the way that you kind of trade. That's the kind of trades you want to be taking. And as you take those trades, you'll grow in confidence as you see the fundamentals working out. Obviously, look, it takes time to learn this, and that's the difficult bit. You've got to put the hard study in, but if you do, the rewards are there. Okay. So that's why we provided these great resources, professional resources that professionals use to help you have those same tools. And obviously, I do every single webinar here at Financial Source every single day. So if you're an HYCM client, you don't need to be more than 24 hours away from getting some advice. You can ask me any question at any time on any topic, okay? And I'll be very happy to help you at any time. That's the way it goes. Okay, so that's the question about the pound. Now, we also have some big data out tonight, Australia employment data. Now, there's a lot that could be said here about Australia employment data, and I have written a very interesting article about the Reserve Bank of Australia. Okay, and the key thing to take away for now is that unemployment is very important for the Reserve Bank of Australia. What the Reserve Bank of Australia really are focusing heavily on is employment. Now, the data comes out 2:30 a.m. UK time, 1:30 GMT tomorrow morning. Now, if you look here, you've got the expectations and the low and the high expectations. Now, the way you use this is like this. The employment is expected to come at 30,000 extra jobs. The high mark, in other words, of the economists surveyed, the highest reading was at 45,000. The lowest reading was at minus 10,000. So for this to come in strong, it needs to come above 45,000. That would be what's called above maximum expectations. That's the most bullish outcome. The most bearish outcome would be if it's below minus 10,000. In other words, there's a fall in jobs and it's below minimum expectations, which is like minus 20, 30, etc., etc. And unemployment is currently at 5.5%. Now, I've got an article I've written extensively on this. I did some quite detailed research on why the RBA, I think, they're wanting for an unemployment around 4%, a figure not seen since the early 70s. So that explains why they've been so dovish in all their outlooks. But if that unemployment comes in, minimum expectation is 5.4. Say that comes in at like 5. If that comes up under 5, expect the Australian dollar to absolutely soar higher. Okay, so you want to pair that against like a weak currency, something like the Australian dollar Swiss franc, the Australian dollar Japanese yen. You'd expect that to rock higher. The only problem you've got to watch with the Swiss franc and the Japanese yen is they're risk currencies, and if the market turns risk off, you could see some yen strength. Okay. So that's key RBA data coming out. But remember, the Reserve Bank of Australia is very sensitive to employment data. Now, all these economic events, okay, they're not all created equal, and they're not all equally important at the same time. So let me give you a picture. Let me explain this to you. So say like I had a conversation with you, and I said, we're going to meet one of my relatives, okay, and I'm concerned about my relative because I think they're getting forgetful. And what they've said to me, 10 times in the last week, they've told me about a special jam they made. Okay, they keep telling me, they keep forgetting. They've told me, I'm really worried. Now, if you went into that meeting with a relative, and if my relative reminds me about that jam again, what am I going to be? I'm going to be really worried. And I'll start saying, I'm really concerned about person. And someone might say, well, look, they only forgot the jam once. Anyone can forget it. And you say, yes, but you don't realize that they've been focusing on that 10 times before. And then it makes sense. The central banks tell you what they're focusing on. And right now, the central bank is focusing on the employment data. That means at this point in time, this becomes very, very important, which means you see strong reactions from it potentially. Now, if the data print comes in as expected, you won't necessarily see a reaction because that's what the market's expecting. But it's if you go above or below the minimum expectations, that's when you start to see the change. Similarly, we have another data point out today, which is the New Zealand dollar GDP. Now, the Reserve Bank of New Zealand, I'll show you something here. The Reserve Bank of New Zealand have brought forward interest rates to the first interest rate of 2022. So like the Bank of Canada, they have brought forward interest rate hikes. Now, don't you, that if a central bank brings forward its interest rate hikes, that's going to make the currency appreciate, right? Well, there's an issue here because even though the Reserve Bank of New Zealand have done this at their last interest rate meeting, the New Zealand dollar, which you can see here in purple, has not been moving higher as it should. Now, what this means, and markets get like this, when there's something fundamental to mean the market should move higher, but it doesn't, it means when you get one bit of data that reminds the market, oh, actually, there's a good outlook for the New Zealand dollar, you'll suddenly see the New Zealand dollar rip higher. So one currency pair to look at is the New Zealand dollar, Canadian dollar. I'll run through the reason. Got GDP. If the GDP is very strong for New Zealand, this could result in some significant upside in the New Zealand dollar, Canadian dollar pair. Now, the CAD, Canadian dollar, has been strong, right, since that interest rate decision. But remember, that was all back in April now. So all the strength in the Canadian dollar, which is here on the pink line, has been priced in. So we've had, 21st of May, we've had 2 months for the Canadian dollar to appreciate. So it's done. It would need something really good for it to keep moving higher. So what that now means is that the Canadian dollar is due a retracement lower, but the New Zealand dollar, particularly if the GDP is higher, that should have been moving higher anyway, because the Bank of New Zealand have said, we're thinking of raising interest rates in 2022, which is early. So you'd expect the New Zealand dollar to get good GDP data tonight, and that is going to be the catalyst to push that higher. So that would mean you want the GDP coming in year on year above, so it's 0.9% expected. It's got to come in above the high, above 1.1%. If it comes in above 1.1%, that's the excuse the market needs to send the New Zealand dollar, Canadian dollar higher. You understand? The quarter-on-quarter reading expectations are that you're going to get 0.8% is maximum, 0.5% expected. Anything above 0.8, send the New Zealand dollar, Canadian dollar pair higher. So that's the fundamental reasons. Here's the technicals. It's a whole different topic, but basically you can just see, and this is like one of the simplest ways of trading, and I love trading this way, which is simply trading very simple trend line breaks. When you have a strong fundamental story and you have a simple trend line break, it can be very powerful. You see this very simple trend line from May's high down to 11th of June. That trend line now becomes a significant line in the sand, okay? If price stays above there, this is a trade I am in. It is more speculative because we haven't had the GDP meeting out, but I just think now's the time, okay, for this to move higher based on just experience and gut instinct. If you keep trading, eventually you'll develop these skills. Just happy to take the risk. And as long as price stays above that trend line, I'll stay with the trade. If price moves back below that trend line, I'll just cut the trade, take my loss. So I've limited my risk very closely, breaking through that trend line, nicely moving in the right direction. I want to see this push up higher. First target up to that 0.8800 level. First target always up in your key overhead resistance levels, okay? So that is one trade that you can look at for the New Zealand dollar, Canadian dollar. Now, I'll give you a tip. If that comes out higher, the GDP data, this will move higher, okay? But then one place you can enter is a simple retracement back down to this level here. If you go into the intraday chart, you'll see that that comes in just around that 0.8700 handle. So if GDP does surprise the upside, look for a retest of the 0.8700, and that can potentially go higher. Now again, so that's not trading advice, but that's just a technical analysis of that pair. And given the scenario that we may see some higher GDP, given the outlook with the New Zealand dollar weaker when it should be stronger, and CAD seen a lot of that strength priced in, it's reasonable to expect New Zealand dollar higher, CAD weaker. Remember what we said. Remember the key aspect. This is the heart of understanding your training. Strength against weakness. Okay, you want to pair a strong currency versus a weak currency. That's what we're trying to do. Come back here. Lo and behold, we're trying to pair strength with weakness. That's where we're looking at potentially a New Zealand dollar CAD. Okay, so now you understand the concept, you understand the ideas. Okay, finally, we're going to go to the SNB. Now, the Swiss National Bank is the world's the central bank with the lowest interest rate. So interest rates are like minus 0.75% out of the Swiss National Bank. So here's what to look for. Again, this is only after the FOMC. If the Swiss National Bank, if they say, we're concerned the Swiss franc's highly valued, okay, I'll explain to you what the Swiss franc what the Swiss are worried about. Do you see? Remember the 2008 financial crisis? Do you see how the Euro-Swiss franc pair has fallen? Now it's fallen from like 1.6, 1.7 all the way down to 1. Okay, it's just above 1.1 at the moment. Now what this means is that the Swiss franc has got stronger. Now the Swiss export a lot of goods. You think of luxury goods that are export from a country, and you often think of Swiss luxury goods, don't you? The watches, the chocolate. You think of the high-end products that come from Switzerland, so many. Now what that means is when they're exporting their goods, if their currency is strong, it means that their products are getting more expensive to other people. So if their products are getting more expensive for other people, what do you think happens? Yeah, you've got it, people don't buy the goods. So the Swiss National Bank don't like seeing the Swiss franc getting stronger and stronger. So what the Swiss banks say is that they say, well, we think the Swiss franc is highly valued. And now at one stage, they tried to artificially weaken the Swiss franc. So they said, we're going to hold this level at 1.2 by buying a virtually unlimited amount of euros and dollars, just to push up that euro-Swiss franc pair. They held it for about 3 years, and then eventually they collapsed. That very famous moment, hedge funds went bankrupt, some brokers even went bankrupt, as traders were betting everywhere that the Swiss National Bank would hold that 1.2 level. They didn't. Important lesson to learn in the markets: unexpected events can and do occur. Nothing is infallible. There's no unlosable trade. There's no surefire winner. Everything is fallible. It's just like life. Everything breaks, everything dies. Everything in the financial markets is uncertain. So learn that lesson now, because you'll learn it the cheap way if you trust what I say. Now, the Swiss National Bank stopped defending the level, and the level collapsed. Right. So fast forward to today. What's going on? Well, they're still worried about the strength in the Swiss franc. They hate seeing the Swiss franc get stronger. So they want to see the euro-Swiss franc pair go up. Now, it's fallen to this key support level. This could be a great area for the euro-Swiss franc to potentially move higher. What would be a great catalyst would be this. If the Swiss National Bank said something, we're going to, buy some euros, more euros again. We're going to openly try to defend a level. If they had anything like that, expect euro-Swiss franc to rocket higher. This could be a good area for a speculative long. That's not, I'm not long the euro-Swiss franc, but if it fell lower, I'd be very interested. I think about that 1.075, 1.65. I would happily hold that with stops, below that 1.0400 level, looking for a longer term move. Now, the main event of today, of course, is the FOMC interest rate meeting. That's what we want to know about. How to trade that? Well, thankfully, it's quite a tricky decision. So I'll just run through it with you. The bottom line is not a whole lot as expected in terms of language, and the Federal Reserve, you can see what the market thinks about the FOMC. For those of you who are more advanced, this will make sense to you. You can see that the bond yield has moved down to that 1.5% level. You see the way the bond yield has fallen. So as yields fall, that's bonds being bought. So investors are saying we're not expecting interest rate hikes anytime soon. We're not expecting a bullish Federal Reserve tonight. That's why the bond yields keep moving lower. That's why they've sat underneath that 1.5% level. So the investors are expecting the Federal Reserve to be more dovish tonight. So this is, remember what I said about expectations? Remember I said about a meal? If I said to you, you're gonna have a bowl of soup, but we end up going to the Ritz, you're surprised, right? This is what we're looking at. When we're trading central bank decisions, we want the surprise because the surprise gives us the movement in the currency. So the most hawkish, remember hawkish means buying, hawkish, bullish is buying. If they drop the language about some time, so that's, they don't expect to keep the easy monetary policy for some time. And if they say we're making progress towards our goals, but they might say we're not enough to yet start tapering, that's fine. But if they upgrade the 2021 forecasts and the 2022 forecast for inflation, in other words, remember when inflation rises, that means if they do upgrade that forecast for inflation, it's the Federal Reserve saying we're not expecting it to be temporary. We're expecting it to be more serious, okay? So that would say the bank is less convinced about the transitory nature. It means they have to raise interest rates earlier. And if the dot plots, now let's just see if I've got a dot plot here. I'll show you a dot plot. Let me just call you up one. Right, here's a dot plot. And I'll explain to you how it's used. Let's find the right one. We'll get the Fed's dot plot. Right, here we go. Right, this is the dot plot, and what the dot plot does, this isn't the one at the moment, but what it does, it shows you what investors are expecting interest rates to be. So it tells you what they're expecting interest rates to be. So when it says here about a shift in the dot plot, if the dot plot moves towards a 2023 rate hike, then that will be a hawkish scenario. And we'd expect to see the US dollar higher, gold lower, equities lower. Remember, if interest rate hikes are coming, companies will be making less profits because loans cost more money, and because of the harder business conditions, equity markets will fall, US dollar will fall because the dollar strengthens, US dollar CAD upside. Okay, so feel free to take a screenshot of this because this will be helpful for you. Scenario 2 is if it's consensus but slightly less dovish. So if this is basically similar to the scenario 1, but they don't change the language, they upgrade the inflation projections but only modestly, and they maybe only just see a 2023 interest rate hike. That would be dollar strength but mild, US dollar weakness, US dollar CAD upside, equities lower, gold lower. This is the most dovish scenario. So if in this scenario there was no change to the statement, and Fed says, you know, we're not going to talk about tapering yet, and there's no upgrades to the 2022 forecasts in inflation. In other words, they're saying we expect inflation to be transitory, and the dot plot median remains unchanged, and the first interest rate hike is still for 2024. That would be a quick upside in gold, upside in equities, upside in the US dollar, downside in US dollar CAD, downside in the US dollar and US dollar 10-year yields. So big event. They're the hawkish and dovish scenarios. Okay, so that's what to look for. That's what I'll be looking out for coming into the event. And also, if we have a very dovish scenario, there is something else to point out to you. And I'll put this up on our blog and on my Twitter feed this morning. You're looking at the South African Rand. Now, the South African Rand, you can just see it here. South African Rand sees a very strong seasonal pattern at this time of the year. So this is, you know, I've put up quite a few seasonal patterns. I really like seeing seasonal patterns. And the South African Rand has gained in value 12 times between June the 7th and July the 30th. So if we do see a dovish FOMC, the South African Rand has a very strong period of time. So that would mean US dollars are selling. Could be a great trade. Okay, and it's really worth looking at. So if you just look here, you can see here that South African Rand strength. Do you see how strong, how pronounced it is? And if you just go, here we go, just go through the video, you can see here the gains. There's been 12 gains in 15 years, only 3 losses, and the average return is 2.30%. So you can see there's potentially some great opportunities. Make sure you always check out HYCM seasonal. I tried to flag up seasonal patterns that are relevant, and this is just one example where I tried to put that together. Folks, I'm going to get through to the questions and answers now. So I'm just going to go back to the main page. Yeah, hi, Ibrahim. Yeah, what does a negative yield curve mean? So that means when interest rates are expected to fall and fall into the future, Ibrahim. Yeah, Ibrahim would like me to look at the chart pound Swiss franc. Absolutely. Now, pound Swiss franc has potentially some nice upside. So we'll just take a look at that. Very interesting chart to look at. Very similar to the pound yen pair that I'm looking at potentially trading. So let's just have a look at that. Now, the best time to potentially enter this will be after the FOMC interest rate decision. Now, let's just have a little look here. Yeah, medium term, we'd expect upside. Why? Because the outlook is bullish for the pound, and as long as the global vaccination program keeps working, we expect weakness for the Swiss franc. So the pound-Swiss franc pair, we would expect to find upside medium term. Now, where to define and limit risk? The best place to define and limit risk here is just underneath that trend line there. So in other words, stay above this trend line. I would define and limit my risk underneath here. So stops running below 1.2540 would make sense. Looking to target that 1.300 area. Okay, just in this near-term resistance. Okay, so that would be the target. Best to wait till the FOMC's out the way because that's risk. And the downsides of this trade, Ibrahim, would be if we see the FOMC being very hawkish, then we'd expect equity markets to fall. And if equity markets fall and bond yields fall, that could easily accelerate into a risk-off trade, which would see the Swiss franc strengthening. So the place to define and limit the risk is just there underneath that 1.2540 region, looking for a move, twice what you risked up into that 1.300 region. But medium term, you'd expect pound Swiss franc buyers. The only thing to watch out for is if we don't see risk-off trading. The upside is heading into the Bank of England meeting next week, Ibrahim, expecting some hawkish comments. So entering in anticipation of the Bank of England, remember anticipation is key, is a great looking trade. So I do like your trade idea. It's in line with the fundamentals. There's some sensible technicals to limit your risk. It's all adding up to me, Ibrahim, that makes sense. Yeah, Syed, hi, Giles. Thank you for your explanations. It may be unrelated, but what impact should we expect on the US dollar ruble and WTI after Putin-Biden meeting that happened right now in Geneva? What's your opinion? Thank you. Okay, so let's have a look. I haven't looked at the details. So the sort of things that could impact the US dollar ruble is more likely to be the FOMC, okay? Just seeing if there's anything up. Right, there's nothing that's coming out to me at all. Now, what we do know about Putin and Biden is that President Biden is, genuinely kind of opposed to Russia. And so the tension between Russia and the US is come back. President Trump he wasn't necessarily pro-Russia, but he wasn't on Putin's case. And obviously Putin was quite happy to have President Trump as the US president. So there are more tensions in between the relationship side. Now, the US dollar ruble pair is called a petrocurrency, okay? So a petrocurrency is a currency which is influenced strongly by oil prices. So let's just call it up here. So there's two major influences on the US dollar ruble side. One, it's petrol prices. Now, as petrol prices rise, okay, that means the ruble strengthens. So let's just pop in US oil. We'll just put US oil over the price, right? And you can see, look, okay, rising oil, falling US dollar ruble. That means the ruble strengthening, okay? So when you have rising oil, falling US dollar ruble, okay? Falling oil, rising US dollar ruble. You get the idea? That's why it's called a petrocurrency. So number one thing, trading the US dollar, Russian ruble, look at oil prices. Number two thing is, or the second thing I should say, is that the FOMC is going to be important. Now, this is exactly the same trade as the US dollar ZAR trade. This is called an emerging market currency, essentially. So if the Federal Reserve is very dovish, then you'd expect US dollar ruble downside. So they're the main things. Oh, that's very kind of you. Thank you. Oh, Warren, sorry, I've done it again. Right. Warren, thank you. You're a star. Thank you for pointing that out to me. Here you go. So here it is. Sorry about that, Ibrahim. Thanks to Warren for pointing that out. If you look here, you can see that as the price of oil rises, purple line, okay, purple line, you can see that the US dollar ruble falls. Falling US dollar ruble is a strengthening ruble. That's what's called a petrocurrency, because it's pushed and pulled around on the price of oil. So similarly to the Norwegian kroner, similar to the Canadian dollar. Okay, so if you're trading the ruble, you're trading the Canadian dollar, you're trading the Norwegian kroner, you always look at oil prices. Okay, so that's number one driver. Second driver will be FOMC event later. Warren, yeah, Warren, thanks to you, folks. That's all we've got. We've got through the questions. And I hope that's been helpful. I hope that's just firmed up a few things for you. Safe trading, happy trading. Great to have you as HYCM clients. And don't forget, please do make full use of the resources we have for you here. Yeah, thanks, Syed. Warren, good to see you again. Thanks, folks. Take care now and have a very good afternoon. Thank you now. Goodbye.